material than any of the other standards. So it's worth spending a little bit of extra time on. You'll see it's also, in terms of volume, a little bit longer. So just on an actuarially fair basis, you would expect to see more material or more questions come out of this. But the idea that we are protecting clients is, I think, a huge deal in terms of the Code of Ethics and the Standards of Professional Conduct, because that, of course, is our primary goal. What the worst thing that can happen for our industry is to see abuse of clients, and that will cause a failure of confidence in our industry and in the capital markets quicker than anything. So I think it is of additional importance, both from the volume of material and because of the importance of this with regard to what we're really trying to accomplish by establishing ethical standards. So looking at this, Standard 3A, loyalty, prudence, and care. So here we see the word loyalty. Now I know I harp on this a little bit, but remember Andy's pillars. One of those is independence, loyalty. That's the first one. So we've seen it in two different places. Independence, you're free to make decisions. Your decision making isn't tainted. Loyalty means you're making it in the best interest of your client. So independence, loyalty is the first pillar, and here we see that as the first thing in Standard 3A, loyalty, prudence, and care. So duty of loyalty to clients, act with a reasonable care and exercise prudent judgment. So the point here is that we have a duty of loyalty to our clients, and we are supposed to act for the benefit of the clients. Now this is something that you're never going to see reversed anywhere in the curriculum. They will give us a little caveat to this later on, but remember, it's client's interest at the top, your interest at the bottom. There may be some room for discussion in between there, but it's always going to be clients at the top of the hierarchy and your interest at the bottom. So the purpose here, or the point, is to determine and comply with our applicable fiduciary duty. Now, fiduciary duty is, of course, a term that is a little bit difficult to define, but the point of a fiduciary duty is that you have a higher standard of loyalty than would be required in a normal market transaction. So if I'm a buyer and you're a seller, I have some responsibilities associated with any transaction that we enter into. That is, I need to be honest about what I'm selling, and there's some standards for transparency and those types of things. A fiduciary duty means that I am making decisions for someone else. So I have the obligation to make decisions in their best interest, and the point being that a fiduciary duty requires a much greater, much higher debt of loyalty than does a normal buyer-seller type transaction. So we have to determine where our duty lies, and we have to act along the lines of that fiduciary responsibility. And of course, that's why the independence is so important. So we're not, our decision making isn't tainted by outside influences. We know where our responsibilities lie, and we execute those, is the point. Hey, let's look at some guidance here. So what we're supposed to do is take investment action in the client's best interest. Of course, we've said that a bunch of times now. Exercise prudence, care, skill, and diligence that a person familiar with such matters would use. This language, while it might sound a little cumbersome, is actually language that comes out of the fiduciary laws. So in the United States, we have, and we'll get to talk about this later on, but we've seen the migration over, I guess you could say maybe over my lifetime. When I was essentially, back when I was born, we had one standard, and when I was very young, we migrated to another. But we've gone from a prudent man to a prudent investor rule, and maybe beyond that in some areas. But this is the language that would be used in a prudent investor rule. So what is a fiduciary supposed to do? Well, you're supposed to be prudent and careful and skillful and diligent. And there is this requirement that you would act like a person who is familiar with such matters. That is, you're going to have some expertise. So follow your applicable fiduciary duty. Remember that in many cases, the client, as defined here in duty to clients, may be the investing public. That is, if you are a research analyst, you're issuing a research report, it's a buy, it's a sell, whatever it happens to be, you are disseminating that widely. Well, who is your client in that case? Well, your client is the investing public. That is who you have a responsibility to. Looking at some more guidance here, we want to manage pools of assets in accordance with the terms governing the terms of the governing documents. Now, this is a really big deal within the curriculum. We'll see some more of this in a little while, But the notion here is that all investment activity takes place under some formal written governing document. Okay, not government document, that would be terrible. Governing document. Of course in CFA speak, we're going to call that an IPS or an investment policy statement. But the point here is that if we have a governing document and it says we're supposed to be doing X, then we must do X, and we can't do Y without going through a full disclosure and, advance notice of changes and all those types of things. So this is actually a very important point here on this first bullet point. Okay, of course, we're going to use a portfolio context. That is the codification, of course, of the MPT that we see so much. So MPT, modern portfolio theory. So remember that as the idea of a portfolio context. And then voting proxies. What about proxies that come into a money manager? Well, if you are going to have discretionary authority over a portfolio and you are going to receive proxies, can you simply say, well, it's not our responsibility, we just pick securities. So we build portfolios, therefore we're going to stay out of proxy contests. Well, no, that's like having a policy that says, oh, well, we are just in the investment business, we're not going to do what's in the best interest of our clients. Okay, so you have a responsibility to vote proxies and vote them responsibly, and of course to vote them in the best interest of the clients. What about soft dollars? Okay, soft dollars must benefit the client. Now this is actually going to be a big fat hairy deal here in a little while when we get to the stub material. But soft dollars basically means this as sort of an introduction. So imagine yourself as a portfolio manager. You have discretionary authority over a portfolio and you're going to effect a change. So you're going to sell some security and buy another security. Well, in order to do that, you typically would hire a broker. So you are going to hire a broker to buy a security for you. And in exchange for that, you are going to give the broker what? You're going to give him money or her money. Okay, so, well, whose money are you giving to them? Well, keep that in mind. You're giving them the client's money, right? So the client pays those expenses. Well, what we mean by soft dollars is in this arrangement, when you hire a broker, the broker executes the trade. Well, there are occasions where the broker will give something back to the money manager. Okay, that could be some type of research is the typical example that we're going to use in the curriculum. So you're getting some research back. It could be third-party research. It could be something that the brokerage firm initiated on its own. But nonetheless, we're getting something back. Well, the point is we paid with the client's money. So what we get, which is one, execution, and two, soft dollars, ought to be used for the benefit of the client. So soft dollars are what we receive in terms of soft dollars are purchased with client money. Therefore, soft dollars belong to the client or must be used for the client's benefit. And this we're going to see in the stub material here at level 2, and it's going to be a big deal. I think one of the major things that we see after we get past the code and standards at level 2. So you're going to get to see a lot more on that as we move forward. How about recommended procedures? So recommended procedures here, well, of course, we're going to follow all the rules and laws and those types of things. We're going to establish client investment objectives. We're going to talk a little more about that in a minute. But remember, when we talk about objectives, we are essentially going to have two things. Objectives mean two things in the CFA world, and that is that when we specify objectives, we do it along the lines of both return and risk. So when you see objectives, it's not like I want to retire early. That means a risk statement and a return statement. Of course, we have the obligation to diversify. Once again, this is the MPT thing, modern portfolio theory, like we saw at level 1. We're going to deal fairly with clients, of course. We're going to disclose all possible conflicts. We're going to talk a lot more about this before we're done. And, of course, vote proxies in the best interest of the clients. That's a requirement. It's something we're going to always have to do. Continuing with recommended procedures, we're going to keep client information confidential. We're going to have a lot more to say about that also. We're going to seek best trade execution for our clients. So that has to do with the selection of brokerages, of brokers. And of course, as always, without fail, okay, it's always going to be the case that the client's interest is going to come first. So that is standard 3A, loyalty. I think that's a big deal. Like I said, my pillars, independence, loyalty, and then diligence, reasonable basis, then suitability with the caveat following on of disclosure if there's problems in any of those other areas. So this is, of course, one of my main pillars, one of the main points of the underlying material. All right, so let's move on to standard 3B, fair dealing. I think this one is actually a little harder to define, and there's more caveats and more gray areas associated with this one. So it takes a little while to get on top of, but it's also very testable. And of course, here, when we talk about fair dealing, this actually means we are taking some action or making recommendations. So it is easy to see when we are going to have breaches of our ethical responsibilities. Loyalty is this sort of nebulous and intangible concept. Well, are you being loyal or not? I mean, we can see evidence of that over time, but fair dealing can be viewed in a single transaction. So this is something that's going to be important. So deal fairly and objectively with all clients. That all is going to become important, and we're going to have to be careful about how we define that. When you're providing investment analysis, making recommendations, taking actions, basically any of your professional activities, we have to deal fairly with our clients. Now, what about some guidance here? Now, no discrimination against any clients. Okay, keep that in mind. So we're going, because this is going to be our guiding principle. No discrimination against any clients when you're doing stuff that has to do with the investment function. Okay, your professional activities, disseminating recommendations, taking actions, all that sort of stuff. Now, remember, and the reason that is hard sometimes to get a handle on is because it is true that fair doesn't mean equal. So for instance, in the last bullet point when we're talking about different levels of service, well, different levels of service are okay as long as it's disclosed and those types of things. But in the process of establishing different levels of service, you have gold-plated service and you have normal service, you can't disadvantage a client. So what you could do is you could say, look, we have clients whose hands we hold. Okay, we go back and we will sit down and talk with them about the securities and about the advantages of portfolio diversification, and we'll counsel them on, special assets or whatever it happens to be. And they're paying for those enhanced services. That's fine. But in the process of providing those, we can't disadvantage any other clients. So what we couldn't do, for instance, is we couldn't have two levels of service where one of those is going to be a situation where the higher level of service gets all of the good securities. So if we got, again, the best example is the hot IPO. So if you've got limited shares in this hot IPO, well, you can't allocate all of those to your clients that reimburse you the way you like to be reimbursed or whatever it happens to be. So fair doesn't mean equal, okay? But regardless of what else happens, you can't discriminate against any client. That's the main point, so keep that in mind as we are going through. How about some more guidance? So when we're talking about investment recommendations, and then we'll talk about actions and to get us through. So looking at investment recommendations, okay, well, remember, all clients must have a fair chance to act on every recommendation. So what would that mean? Well, if we're sitting down and imagine yourself that you have 20 clients and one of them is the big daddy, and that's the one that generates 70% of your operating revenues and all that sort of thing, and you have 19 others. Well, if you sit down with your one big client and you talk about the change in recommendation and how that's going to impact their portfolio, and you take their directions for changes, and then you hit send on your email and send out the announcement to everyone else, and then immediately start trading for your big client and for yourself, okay, well, you haven't given all your clients a fair chance to act on the recommendation. So you've got to be careful that all clients have a fair chance. Now, what if a client calls up and says, I want to buy security X? Well, yesterday you issued a sell recommendation on security X. Well, can you take that order counter to the published advice? Okay, well, you can, but you have to make sure the client is aware of the change. So you can say, well, we'd be happy to buy that for you, but we need to tell you that we have a sell order on that. If they say, well, that's fine, I still want to buy it, then of course you can take the order, but you do have the obligation to make sure that they have knowledge that they're trading against your recommendation. Some more guidance. So investment actions here, okay, of course, treat all clients fairly. Okay, that means we have got to consider their investment objectives and circumstances. More coming on this in a little while. Disclose your written allocation procedures. So this allocation, remember when you see this word, the best example is how you distribute hot shares or shares in a hot IPO rather, okay, and you can't disadvantage any client under any circumstances. And again, there's the hot issues example coming on. So moving to recommended procedures. have a couple of slides for this, and that'll get us through this 3B. So recommended procedures. Well, when we're talking about dealing fairly with all clients, imagine ourselves having a research department. The research department is looking and saying, well, we've got an upcoming change. So analyst is recommending take this from a buy to a sell. You have some sort of committee that has to vet that. Okay, so there's some sort of committee process before it's disseminated externally, which is recommended in the Code of Ethics, by the way. So it's a recommended procedure that you have some sort of vetting process. Well, think of these first two as applying to that situation. So one, you want to limit the number of people aware of upcoming changes. So you can have 5 people, you can have 25 people. Well, all else equal, it's easier to control the actions of 5 people and make sure you have fewer information leaks, all that sort of stuff. And shorten the time frame. Once the decision's been made, well, don't keep it secret for 2 weeks. Let's disseminate the information. So limit the number of people, shorten the time frame on recommendations. A great idea. Okay, of course, we're going to have some pre-dissemination guidelines about how we behave, what information we can give out, what the trading activities of the employees are going to be. We're going to strive for simultaneous dissemination. That may not be possible, but that's the ultimate goal. And we're going to maintain a list of clients and their holdings so that we'll know who's impacted by this. So if we're going to change from a buy to a sell, we know which clients are holding that in their portfolio, and we can give them a heads up. And then, of course, our trade allocation procedures ought to be disclosed, as we've talked about before. More in the way of recommended procedures here. We ought to review accounts regularly to ensure that our clients are being treated fairly. This is a big deal to go back and look at client accounts, but nonetheless something that we ought to work on. If the firm offers different levels of service, we have to disclose that to all the clients. So we want to make sure that all the clients are aware that there's different levels of service, and they should have access to those different levels if they're willing to pay for it. Deviations from strict pro rata allocation, sometimes okay. I like to see this sort of thing in the ethics material because this is a nod to the details of the actual practice in our industry. So we have some sort of allocation procedure in place. It says it's going to be a pro rata allocation based on portfolio size or something along those lines. Okay, well, what if that would lead to a case where we're going to put, like 2.3 shares of a stock into a portfolio that has a $2 billion value. Well, putting 2.3 shares of stock into a $2 billion portfolio probably doesn't make a lot of sense. So there may be some deviations from the strict pro rata allocation to allow for some practical considerations like minimum block size and those types of things. So we see that in a couple of places in the curriculum where they're giving a nod to the fact that we still have some practical considerations that everyone would agree are relevant to our code of ethics, and this is one of the manifestations of that. All right, so that is fair dealing. So let's move on to suitability. So remember, this is the third of my pillars. So independence, loyalty, so diligence and reasonable basis, then suitability. So here we see the suitability requirement. And this basically says that when you're dealing with clients, you have to make reasonable inquiry as to the client's investment experience, okay, their risk return objectives, that's a biggie, and their financial constraints prior to making any recommendation, and then you're going to update this information regularly. What we need to talk about, okay, is what this means by objectives and constraints primarily, okay, what it means to make reasonable inquiry, and then what this word regularly is going to mean for us on the exam. So the notion here, and what we're getting at, is that it's not enough to be diligent in understanding the underlying assets. So we've got some share of stock that we are considering investing in or recommending to our clients. We go through and we do lots of due diligence on that. We talk with the management team. We talk with other analysts. We do lots of analysis. We've got all our models out. We're really working it hard. And then we just say, well, let's buy it for everybody. Well, you can't do that because every client is different, and it's diligence, reasonable basis is going to refer primarily to the asset. Suitability refers to the client. So you've got to consider the client situation also when you are making recommendations or taking actions. So continuing on here, so we see that there's actually 3 sides associated with the standard itself, which tells you it's a big one. But nonetheless, we want to ensure that the investment is suitable to the client's situation. So that, I think, is the heart of this, and it has to be consistent with the written objectives. So we talked about that before in Standard 3A, but remember, if we have a governing document, and we should have a governing document, that's going to be the IPS. You'll see a lot of that at level 3, a little here at level 2, so a bit at level 1. But if you have an investment policy statement, that's the written document. It says you're doing X. So if it says you're going to invest long only in, let's call it high yield bonds. Well, you can't look at that and say, okay, we're long only high yield bonds. That's the limit of our investment purvey. Then we are going to say, well, let's have some sort of derivatives overlay. Well, if that's not consistent with the written objectives, you can't do that. So I view this as two standards. One is the economic standard. Is this suitable? And the other is the technical or legal standard. Is it authorized under the governing document? So, and of course, we're going to look at suitability in a portfolio context. Finally, to finish out the standard itself, then we can move on to some guidance stuff. When responsible for managing to a specific mandate, and that can be anything, a strategy, style, or something along those lines, take actions that are consistent with the stated objectives. That's something that we reviewed also on the last slide. So I think we've sort of done that to death. So let's look at guidance here. So in terms of guidance, what do we need to know? Well, remember, when in an advisory relationship, gather client information at the outside and at the outset and prepare an IPS. Okay, so we have to have this investigation period where we ask probing questions and we come to understand what the client's objectives are. Remember, objectives in terms of risk and return, and what their constraints are. And we'll see some list of constraints later. You'll see it again in some portfolio theory stuff in other study sessions. Okay, so nonetheless, we have this. They have these objectives. That's risk and return, constraints. All of that goes into the IPS. Now, the IPS is a lot broader than just those two things, but those are the two things that we're worried about at level 2. So what about the update? We have to update this at least annually. Now, what does that mean? Well, the thing to recall here is that this requires an effective update. So if you have an investment manager that goes in, does a great job of writing the EPS, goes in, understands their clients, asks lots of questions, reviews the background, does all those types of things, and then on the anniversary of the engagement, calls up the client and says, hey, how's it going, Bill? And Bill says, fine. Hey, anything change? Anything I should know about with respect to your portfolio? Well, no, I think everything's about the same. Okay, well, we'll keep on keeping on then. Well, that's not an effective update. So there has to be an effective update where there's some attempt to probe, find out what the changes are and those types of things. So if they're just having their assistant call or if they're just having a cursory phone call, that is not going to be an update. It's got to be effective. Consider whether leverage or derivatives should be used. And of course, if you're managing a fund or an index to a mandate, you have to invest according to the mandate. We've said that several times. So keep all that in mind. What about recommended procedures? Well, the recommended procedures are pretty light here. So two things. One is going to be this notion of objectives. We've already said a couple of times here that objectives take on two forms or two avenues. There's two things that have to be discussed in other objectives. That is return objectives and risk tolerance. So both of those things constitute objectives. And we deal in a risk-return world. And then what about constraints? So the IPS, from our point of view, two things. Objectives and constraints. There are 5 constraints. Those are liquidity needs, okay, time horizon, tax considerations, regulatory legal constraints. All of those are fairly self-explanatory. And then unique circumstances. Those are things that by definition need to be considered when forming the portfolio, but that are not considered elsewhere in the constraints. Now, in this list, you also have expected cash flow and investable funds. I think those are certainly things that we could talk about. You'll see later when we talk about this, and what you saw at level 1 was the 5 constraints that are underlined, I think, are the primary ones. So those are the ones that I would focus on for purposes of the exam. So liquidity needs, time horizon, tax considerations, legal, regulatory, and then unique circumstances. And that is standard 3C. Which allows us, of course, to move on to Standard 3D. And there's an important caveat here in Standard 3D that you need to be aware of. So in a little while, we're going to talk about this thing. Well, no, we're not going to talk about it. We talked about it at level 1. Did I do this right? So I'm messing with my stuff here. Hold on. Well, okay, here we go. That's all I really wanted to do was type up GIPS where you could read it. So anyway, the notion here, at level 1 we talked about GIPS. You'll hear about this again at level 3. Stands for Global Investment Performance Standards. Okay, basically those are guidelines for how we present performance. Now look at 3D. We're dealing with performance presentation. So performance presentation, presentation standards, are those two things linked? Yes, they are. But how are they linked? You need to be really careful with this. So the standard is this. When communicating investment performance information, we have the obligation, we have 3 important words here. Okay? The information we give has to be fair, accurate, and complete. Remember that, fair, accurate, and complete. That is an ethical responsibility. What does that imply about GIPS? Okay, well, GIPS is a voluntary system, so we are not obligated to use GIPS. Okay, the Global Investment Performance Standards. GIPS is a tool that we can use that might help us deliver fair, accurate, and complete information. Okay, but if we choose not to use GIPS, well, we don't have to go and use their exact calculation standards, all those types of things, all their disclosures. Okay, but if we opt not to use GIPS, we are still responsible under the ethical requirements to give fair, accurate, and complete information. So, in other words, if we have a portfolio manager, they've got 20 high-yield bond funds, they want to solicit some business from somebody else who wants a high-yield bond fund, they grab one of those funds and say, look, for this investor, we have returned 18% on average over the last 5 years. Okay, well, that is accurate information. That portfolio actually exists, but it is neither complete nor is it fair because it doesn't adequately capture what that manager has accomplished. Because when you looked at all 20 portfolios, they actually have a minus 3% return over the whole group. So we have an obligation to be fair, accurate, and complete. We have no obligation to use GIPS, but GIPS is a tool that may help us to meet our obligations. Also, another one of these nod to the actual practice that we have in the ethical standards. That is, what about a brief presentation? Well, if you're asked to make a 6-minute presentation, you can't spend 14 minutes limiting comments, right? So talking about all the disclosures and those types of things. So brief presentations are okay, but you do have to note the limited nature and make more detailed information available upon request is the point. Okay, so what about some recommendations here? Some guidance here. So looking at guidance, well, we're not going to misstate performance or mislead clients about investment performance. And remember, on the exam, when you're looking at or when you're reading a scenario on the exam, you can gauge intent. So if you have someone who is trying to say, they're never going to lie. Everything they say is technically accurate, but they're trying to suppress information or they're trying to subvert some aspect of their performance, then they are violating the standard. It has to be full, fair, and complete. So be careful about that and make sure that if you have somebody who's trying to weave through the guidelines, then they are violating the guidelines, right? So don't misrepresent past performance. We have to have fair and complete information. And of course, if you practice in any developed country, you probably already have this on the these laws on the books, and that is that you can't tell your client that you're going to achieve certain returns. You can't guarantee returns in the future. Okay, and that brings us to recommended procedures. And so recommended procedures here, well, we can consider the audience sophistication. And if you go back a couple of generations in the ethics material, so a couple of generations through the book. We're, of course, in the 10th edition, the edition that came out in 2010. It's the one you're responsible for. But if you go back, this clause was added just a couple of generations ago, and I think this is a really important thing. So we've seen a couple of things over the last few minutes about, okay, we actually have to make a living doing this, and there's lots of different situations. So this allows us to consider audience sophistication. So if you're talking to Bill and Ethel, and they are trying to, save $300 a month for retirement, well, that's one situation. If you're talking with the investment committee from a major pension fund, well, that's a different level of sophistication of investors. Okay? So it probably wouldn't make good sense or be a good use of anyone's time to talk about the difference between stocks and bonds when you're presenting to a committee of investment advisors, or the investment committee at a big pension fund, something along those lines. So there is this admonition that we can consider investor sophistication when we're making these presentations. So we ought to use the performance data in weighted composites. So remember, a weighted composite means that we're taking all the portfolios managed to a similar strategy, and we're going to put those together and we're going to report them as a group. So we're not going to pull out that one representative portfolio that performed really bad or really great and put that forward as typical performance. So we're going to include terminated accounts. So we talked about this a little at level 1, but the idea here is if you're reporting 5 years of data in the past, well, 2 years ago you had a client leave you. So if you're reporting 5 years of data, they're still in there for 3 years. They're not in last year or the year before, but they're in for the 3 years before that. Well, the point here is if we exclude terminated accounts, we're going to be very likely biasing performance up, averages up, and then volatility down. Why? Because no one has ever called their investment manager and says, hey, you're making me too much money, I'm going somewhere else. It's the accounts that underperform that leave, right? So you have to include terminated accounts that were under managed, even currently accounts that are no longer under management but were under management during the reported performance period. And then of course make disclosures and maintain records. That's going to be a big deal. All right, so that is standard 3D. Let's move on to standard 3E, preservation of confidentiality, and as you might guess, this is going to be relatively straightforward. In our industry, we receive lots of confidential information. People are admittedly careful about giving out their financial data, right? So they're sort of taking off their financial clothes. So when we're dealing with clients, okay, we have to keep that information confidential unless illegal activities are suspected. Okay, now this doesn't say that we have to disclose it if we think the illegal activities are suspected. It's just that the standards here don't prevent us from disclosing that to authorities if we suspect illegal activity. Okay, what about disclosure as required by law? Well, these two things can certainly be related, right? So in the United States, if you believe that your client is laundering money for whatever reason you become aware of that, then you have to disclose that. And then client or prospect allows disclosure. Well, if the client says, sure, you can tell this organization about my portfolio construction, well, then they are giving you permission to extend that confidence to some entity, and of course you would be within your rights and within your ethical responsibilities if you did that once the client had told you that it was okay. Some guidance stuff real quick. In some cases, it may be required by law to report activities. We talked about that with money laundering. The standard does extend to former clients. So just because someone leaves our shop doesn't mean that, well, now we can take all their personal financial information and spread it all over. Okay, there is an exception here. And I don't know that this has ever happened, but what comes to mind is this. There was a client that complained, and this is just a story I'm telling. There was a client that complained to CFAI about the activities of investment manager. The CFAI initiated a professional conduct program inquiry. That is, they're going to investigate whether there was any malfeasance or wrongdoing here. And they went to the person who's suspected of wrongdoing. They said, we need to look at the trades on this portfolio. And the person says, well, that's great, but I can't disclose that information to you because it would be a violation of the ethics requirements that I'm obligated to under the CFAI standards. So in other words, they were using CFAI standards to not cooperate with CFAI. Now, I don't know that ever happened, but this would prevent it from happening if it were ever to occur. So what this says is, it doesn't say you have to disclose data to CFAI. Okay, what this says is that you may disclose data to CFAI without violating the ethics standards. So you can't use the ethics standards here as a reason to not cooperate with the inquiry. And that brings us to recommended procedures here. And the idea is this is confidential information. Keep it to yourself. So you only discuss it with colleagues who are working on the same project. It's a need-to-know basis. You need to know. You don't. So don't tell people that don't need to know. Of course, most firms have some sort of electronic data storage policies. If you don't have those, you should be recommending them to your firm. But given that they exist, you should, of course, be adhering to those so that you can protect your client's confidentiality. And that is the end of that very important Standard 3. which of course brings us to standard 4, which is our duty to employers. Now, let me tell you how the game I play to interpret duties to employers on the exam. So I don't know anything about how this material is put together. I've read the material a lot, studied it, feel like I know the ethics material pretty well, but I've never been interested in the history of where it comes from. So this is just my imagination working. But when I read the standards and when I look at the application of that on the exams when I was taking them and when I work practice exams, this story fits pretty well. So imagine this having been put together by a committee of, let's say, 7 people. So there's 7 people on this committee that's all putting these standards together. They're all professionally qualified, all that sort of stuff. Well, when you read and interpret the standards, just view that committee as having had one too many employers. One too many employers. What do I mean by that? Well, what I mean by that is this seems to be a fairly employer-oriented document. Okay? Now, we have a debt of loyalty to our employers, and this isn't a huge deal. This is just a game I play to help me analyze questions on the exam. So if I'm thinking, well, does this person owe their employer this particular debt of loyalty or this particular thing? Well, if I'm up in the air, okay, then I come down on the side of the employer because, like I said, there was one too many employers on the committee. I don't really know how it was created. That's just, like I said, the game that I play. So play along. I think it actually works. All right, so standard 4A, loyalty. Okay, here we're talking about loyalty to our employer. So on matters related to employment, act for the benefit of the employer. Well, that doesn't seem to be too high a standard, but the follow-on raises the bar a little bit. It says, and do not deprive your employer of the advantage of your skills or abilities. So it's not enough that you are acting for the benefit of the employer. You also have to make sure that you're not doing anything that would deprive them of your full measure of skills and abilities. And of course, we can't divulge confidential information or otherwise do harm. So you can see that this, this is evidence of this idea that we're going to have a relatively high standard when it comes to the duty of loyalty that employees owe to employers. Some guidance here. And so general guidance, and then we'll talk about independent practice. So I'll talk about leaving employers and then whistleblowing, and that'll get it. So quite a bit of guidance on this, in other words, is the point. So here we're talking about loyalty. Remember, we're going to place clients' interests first. Okay, that's always going to be the case. Place clients' interests first, but notice that we do have this caveat, and that is that we're going to consider the effect on firm integrity and sustainability. So we're not saying that we do what's best for the employer over what's best for the client, but this is going to be a consideration. So members are encouraged to give their employers a copy of the code and standards. Many cases they would already have that, but if they don't, then you should do that. Okay, and we ought to work against any incentive or compensation structure that encourages unethical behavior. So if we think the way analysts are compensated is unethical, then we have a responsibility to work towards changing that. Okay, what about independent practice? So independent practice, this means that you're working for someone, you're going to have a client on the side that you service independently and probably works within the same general professional activities that you provide as a part of your employment. So if planning to engage in independent practice, you have to notify your employer of services provided, the expected duration, and the compensation, and you cannot proceed without consent from the employer. So you have to get permission from your employer to do this, so keep that in mind. Hey, what about leaving an employer? The important thing to remember here is there's a difference between leaving an employer and having left an employer, right? So when you're leaving an employer, you've tenured your resignation, but it's not effective, or you know that you're leaving or about to leave, but you're still working there, well, you have to act in the best interest of your employer until your resignation is effective. So until you're actually out the door, you take your pictures of your family down, pack up your briefcase, say goodbye to your friends, turn in your badge, and you're gone. Till you're effectively resigned, you have to act in the best interest of your employer. Remember that employer records on any medium, that can be on your home computer, your PDA, whatever it is, okay, are the property of the firm and have to be returned to the firm or destroyed as agreed. Okay, now, what about after you leave? Well, after you leave, then you still know the clients you were working with. Well, simple knowledge of the names of former clients is okay, but you can't solicit them prior to your effective resignation. And of course, there's no prohibition on using the skills and abilities you learn with an employer. So hopefully you're in a situation where your employer is paying for this video series. Okay, well, if that's true, then that's certainly a great thing. You're going to learn something from it, I'm hoping. And when you move to a new employer, you're still going to take that with you. Those are yours forever. That's the great thing about being a knowledge worker, is as you build your skills, those are intrinsic to you, and you got to take those with you wherever you go. All right, so that's leaving an employer. One last bit of guidance here on whistleblowing, and we will be through with this. We'll be through with standard 4A. So whistleblowing, this says that you have an employer that is doing something unethical or illegal, okay, and you want to blow the whistle on them. Well, when can you do that? You can only do this, okay, if it protects a client or the integrity of the capital markets, and you can't do it for personal gain. So if there's no client interest at stake, there's no capital market integrity at stake, you can't do it, and you can't do it for the purposes of personal gain. So you can't be a whistleblower just to be a whistleblower is what this effectively says. So that is standard 4A. Let's move on now and talk about 4B. And I think I went one too many slides. There we go. 4B. Sorry, I had a little trouble with my pen. So I've got, like I said, 3 screens in front of me and about 7 input devices. So every once in a while, we're going to have one jump ahead. Anyway, so standard 4B, additional compensation arrangements. So here we're talking about receiving compensation outside of the normal flow from employer to employee. So here's the point. We're not going to accept gifts or benefits, compensation, consideration, or anything that competes with or creates a conflict of interest with the employer's interest unless we get written consent from all parties involved. So that's going to be from the employer and from the people that are giving us the additional compensation. Again, it's not enough just to notify our employer. We have to get written consent from both sides, a slightly higher standard than what I might have opted for. I would have just said if you get written consent from your employer, then you're good to go. But we have to have written consent from all sides. So compensation and benefits covers direct compensation by the client and other benefits received from third parties. And it's compensation and benefits. So this isn't just money. So this could be membership in a club or, any sort of preferential treatment. Those types of things are going to be covered by this. And as is the case throughout the ethics curriculum, remember that when we call for written authorization or written consent, email communication is going to be acceptable in those circumstances. Looking at some recommended procedures, the written report to employer that should have the details of the proposed compensation, okay, in addition to the normal compensation and benefits that we're receiving. The details of the incentives should be verified by the offering party. So again, that creates a high standard, and of course should include the nature, the nature of the compensation, the amount, and the nature and the amount and the duration is what I was trying to say. So in my mind, I guess I'd already moved on to the next slide, which is also the next standard, which is 4C. I think this is actually a really important one. So this brings up some stuff that's highly testable, and we have to be careful in how we interpret what's going on here. So what do we need? We need to we're talking about the responsibilities of supervisors. That is, if there is some sort of ethical breach, that means somebody's done something that's unethical. Very likely that person has a supervisor. Under what circumstances is the supervisor culpable in that, and under what circumstances would they be exonerated or not culpable in those misdeeds? So the requirement is that we make a reasonable effort to detect and prevent violations of applicable laws, rules, regulations, code, and standards by anyone subject to our authority. So reasonable effort, that's important, but there's 2 other really important words in this standard. So what are those 2 important words? Find them. Okay, well, the important words that we have to worry about, we have to make a reasonable effort to detect and a reasonable effort to prevent violations, okay, of the code and standards of anyone that works underneath us. So there's really 3 things we have to remember here, and we're going to talk about some caveats of that. But one, what does it mean to make reasonable effort? And what I'm going to tell you is that you need to interpret this with a very high standard, meaning that in order to be counted as a reasonable effort, to not be culpable in any misdeeds of the underlings, then you are going to have to be extremely diligent as a supervisor. Okay? And you have to be working on both sides of the violation. One, to prevent them before they happen, and two, to detect them if they were to occur. So this is an important standard. So guidance here. Supervisors must take steps to prevent employees from violating the laws. They must also make reasonable efforts to detect violations. So we've talked about the prevent and the detect thing. Also, we ought to be enforcing our non-investment rules, things like mandatory vacations. So you want everybody out of the building for a couple of weeks a year. I don't think this is so much an employee wellness thing as it is, this is basically a control, right? So when I was working early in my career in a bank, we had a rule that you had 2 weeks vacation, you had to take it all together, and you had to take it every year. You weren't allowed on the premises during those 2 weeks. And the point wasn't that they wanted us to take a break. The point was that the way you run a scam is you get in there every day to stay one step ahead, right? So if you're gone for 2 weeks, it's harder to manage your scam. Okay, so what about recommended procedures here? And we're going to see a couple of slides on this, and I think that these are important. And while it says recommended, and I've emphasized that as we've gone through, the difference between recommended and required, in this case, I think that these are slipping close to being requirements, all right? So what do we need here in terms of adequate compliance procedures? Well, of course, they need to be fair and understandable. We ought to have a compliance officer. We ought to have checks and balances, and then we ought to have procedures for reporting violations. Nothing too earth-shattering there. But here, when we're talking about the responsibilities of the supervisor, okay, one, they need to distribute the procedures and they need to update those. They're going to review employee actions. That's a big deal, but something they have to be doing. And we're going to promptly initiate procedures if a violation has occurred. Okay, well, remember the word promptly, and that means you should interpret that as immediately for exam purposes. Okay, but the word that bothers me here, and I think is evidence of the high standard that you have to apply on the exam, is this word continually. Okay, so we need to continually educate our staff. Well, in the limit, you can interpret this as supervisors having to go around and spend all of their day educating their staff if that's what you're continually doing. Now, I don't think that's the interpretation for exam purposes, but I can tell you what won't cut it, and that is a scenario where a supervisor brings in a new employee, he pushes the compliance manual across the desk to the new employee and says, look, we take ethics very seriously. I want you to read this, and if you have questions, I want you to come back to me personally or to the compliance officer so we can make sure to get this because it's a huge responsibility. That's not adequate, okay? There has to be an effort, an ongoing effort to educate the staff, and it can't be just saying, call me if you have any problems and those types of things. So continually educate, that's what we're working with. And then finally here, so once a violation has occurred, respond promptly. I would read that as immediately. Okay, respond immediately. We need a thorough investigation, and importantly here, the last bullet point in our standard 4, that is that we need to place appropriate limitations on the alleged wrongdoer during the time of the investigation. So something comes to light, there could have been a problem. Okay, we're going to immediately institute an investigation, but the investigation could take weeks or months depending on how much data we have to dig through and how many client records have to be examined. But while that investigation is going on, we have to place some limits on the wrongdoer to prevent them from damaging other clients during the investigation period. So that's standard 4, duty to employers. I think there's a lot of testable material there, so make sure that you stay on top of standard 4.